Exchange-traded funds, or ETFs, are a popular way to invest. They are like baskets of stocks or bonds. When you buy an ETF, you own a small piece of all the assets inside. Think of it like buying a variety pack of snacks instead of just one type. ETFs trade on stock exchanges, just like individual stocks. This means their prices change throughout the day. You can buy or sell them anytime the market is open. In simple terms, ETFs offer a convenient way to invest in a diversified portfolio of assets. ETFs work through a mechanism known as creation and redemption. Large financial institutions, called Authorized Participants, or APs, play a crucial role in this process. They create and redeem ETF shares based on market demand. When demand for an ETF rises, APs create new shares by assembling a basket of the underlying assets. Conversely, when demand falls, APs redeem shares by exchanging them for the underlying assets. This mechanism ensures that the ETF's price stays close to the value of its holdings. ETFs and mutual funds both pool money from multiple investors to invest in a diversified portfolio of assets. However, there are key differences between the two. One significant distinction lies in their trading mechanism. ETFs trade on stock exchanges like individual stocks, while mutual funds are priced and traded only once a day after the market closes. This difference in trading frequency affects the pricing transparency and flexibility for investors. Another difference lies in their expense ratios. ETFs generally have lower expense ratios compared to mutual funds. These characteristics make ETFs an appealing choice for many investors. ETFs have gained immense popularity among investors due to their numerous advantages. First, diversification ETFs offer instant diversification by investing in a basket of assets, reducing the risk associated with holding individual stocks or bonds. Second, low costs. ETFs generally have lower expense ratios compared to actively managed mutual funds, saving investors money on fees over the long term. Third, trading flexibility ETFs trade on stock exchanges like stocks, providing investors with the flexibility to buy or sell their holdings throughout the trading day. Fourth, tax efficiency ETFs are generally more tax efficient than mutual funds due to their unique structure and trading mechanism, minimizing taxable events for investors. Finally, transparency ETFs disclose their holdings daily, providing investors with transparency into their investments. These benefits have contributed to the widespread adoption of ETFs as a popular investment vehicle. The ETF universe is vast and diverse, offering a wide array of investment options to suit different risk tolerances and investment objectives. Here are examples of popular ETFs across various asset classes. Stock ETFs, SPDR, S&P 500 ETF, SPY, tracks the S&P 500 index. Invesco, QQQ Trust, QQQ, tracks the Nasdaq 100 index. Bond ETFs, iShares, Core US Aggregate Bond ETF, AGG, offers broad exposure to US bonds. Real estate ETFs, Real Estate Select Sector SPDR Fund, XLRE, invests in REITs. Commodity ETFs, Invesco DB, Commodity Index Tracking Fund, DBC, tracks a basket of commodities. ETFs are a powerful tool for growing wealth and achieving financial goals. Their diversification, low costs, trading flexibility, and tax efficiency make them attractive. Investing in ETFs offers exposure to a diversified portfolio, reducing risk and enhancing returns. Low costs maximize your investment growth over time. ETFs' trading flexibility provides liquidity and control. Their tax efficiency minimizes tax liability, enhancing returns. ETFs are user-friendly for both seasoned and new investors.